Hello, my dear students. A very warm welcome to all of you in Shri Jayendra Rank Zone. I am your friend and mentor for the subject Principles and Practices of Accounting. In this lecture, we'll begin with Accounting Chapter 8, Unit 2, that is Treatment of Goodwill in Partnership Accounts. Let us begin. This is lecture number 1. Learning Outcomes. After studying this unit, you will be able to understand when does the need of valuation of goodwill arise. We'll learn the accounting of goodwill, the accounting treatment of goodwill. Unit overview, necessity for valuation of goodwill in case of change in profit sharing ratio between the partners, admission of a new partner, retirement or death of a partner, and when business is dissolved or sold. These are the cases when when the valuation of goodwill is necessary. Let us continue. Methods of valuation of goodwill: average profit method, annuity basis, super profit method, and capitalization basis. So these are the four methods by which we can value goodwill. Let us continue. Goodwill. Goodwill is the value of reputation of a firm in respect of profits expected in future over and above its normal rate of profits. In simpler term, goodwill is nothing more than profitability that old customers will resort to old place again and again. The capacity of business to earn super profit is the future is basically what is meant by the term goodwill. Goodwill is an intangible asset. It cannot be seen, it cannot be felt, it cannot be transported physically. Even then, it is very real. From accounting point of view, it is necessary that it has some monetary or sellable value. The implication of the term over and above is that there is always a certain normal rate of profit that is earned by a similar firm in the same locality. The excess profits the excess profits earned by the firm may be due to its locational advantage, better customer service, possession of a unique patent right, personal reputation of the partner, or for similar other reasons. The necessity for valuation of goodwill in a firm arises in the following ways. A. When the profit sharing ratio amongst the partner has changed, when a new partner is admitted, admission of a partner, when a partner retires or dies, that is retirement or death of a partner, or when the business is dissolved or sold. I believe you understood. Let us take a simple example. There is a small book business owned by a firm. Its net worth, that is asset minus liability, is 1,40,000. Now, if a purchaser is willing to pay 1,50,000 for it, the extra 10,000 that the purchaser is paying is known as accounting as goodwill. The next question is why the purchaser is willing to pay an extra 10,000 for goodwill. One reason may be the future capability of the business to earn more profits other than the normal profit. It may be on account of the favorable location. The major factor which affect value of goodwill are as follows. The list is no way exhaustive but only provides a basic guidelines. The quality of goods sold will affect the goodwill positively. The personal reputation of the owner, that is their ability to attract more customer. The location of the business premises, example, a good position in a congested market. Next, the possession of near monopoly right, example, main agent of a particular vehicle like Maruti car, Bajaj auto scooters, etc. The possession of trademark and patents, the presence of managerial skills, the cost of research and development which enables the production at low cost and of good quality, the possession of special contract for the availability of materials. Recommendation of accounting standards. Accounting standards require an enterprise to recognize an intangible assets only if and only if certain conditions are satisfied. An intangible asset must have the characteristics of an asset. It means that it must have some value and must be clearly identifiable so that it can be sold without disposing other assets or future benefits flowing from the other assets. I believe you understood. Next, an intangible asset should be recognized only if the future probable economic benefits, that is, increased revenue from sales, will flow to the business enterprise and not to others. It means that management can make reasonable estimates about future benefits. Third element, the cost of the intangible assets can be measured reliably. That is, the cost is objectively verifiable. If the cost cannot be measured reliably, then it cannot be recognized as an asset. It is thus clear that none of the conditions is satisfied by internally generated goodwill or inherent goodwill. The reasons are simple to explain. First, it is not an identifiable resource like patent, trademark, or copyright. Second, it is very difficult to assess the future benefit. Finally, the cost of internally generated goodwill cannot be reliably measured in the absence of any consideration in money or money's worth. There is no documentary evidence to support the value of goodwill as a resource. Goodwill should be recorded in the books only when some consideration in money or money worth has been paid for it. Accordingly, an admission or retirement or death of a partner, or even when there is a change in the profit sharing ratio among the existing partners, goodwill should not be raised in the books of accounts of the partnership firm because no consideration in money or money's worth has been paid for it. The conclusion is that only purchased goodwill should be recorded in the books of accounts, whether the payment is made directly in cash or money's worth. For example, A and B purchases the net assets, assets minus liabilities of C amounting to 2,50,000 for 3 lakh. That is, A and B paid 50,000 extra in cash. The additional payment of 50,000 is a payment of goodwill in cash. It is a case of purchased goodwill, an asset, and can be validly recorded in the books of A and B. When no payment is made for the purchase of goodwill and goodwill account is raised in the books, it is a case of internally generated goodwill or inherent goodwill, and as a standard, as an accounting standard, it is not permitted. For example, in the event of reconstitution of the firm due to admission or retirement or death of a partner or even a change in the profit sharing ratio without reconstitution, goodwill of the firm is evaluated. In such a situation, the value of goodwill should not be brought into books of accounts because it is inherent or self-generated goodwill, since no money or money's worth has been paid for it. The only way out is that the value of goodwill is calculated with the help of different valuation methods should be adjusted through capital accounts of the partners of the firm. In no case the goodwill account is to be raised in the books of account, either on the reconstitution of the firm or change in the profit sharing ratio. The amount of goodwill is written off over a period of time. In case when the goodwill account exists at the time of reconstitution of the firm, it should be written off immediately, whether it is internally generated or goodwill has been brought for some consideration. Let us continue. Methods of valuation of goodwill. There are three methods of valuation of goodwill. First, average profit method, that is simple and weighted average profit. Next, on the basis of super profit method, number of year of purchase, annuity basis, capitalization of super profit. And the third method is capitalization basis, that is average profits. We'll begin with the first method, that is average profit basis. In this case, the average profit of past years are adjusted for any expected change in future. The number of years are decided on the basis of judgment and negotiation. For averaging the past profit, either simple average or weighted average may be employed depending upon the circumstances. If there exists clear increasing or decreasing trend of profits, it is better to give more weight to the profits of the recent years than those of earlier years. But if there is no clear trend of profit, it is better to go by simple average. Let us suppose profits of a partnership firm for the last 5 years is rupee 30,000, 40,000, 50,000, 60,000 and 70,000. In this case, a clear increasing trend is noticed and therefore average profit may be arrived at by assessing appropriate weights as shown below. Year 1, 2, 3, 4, 5, profits is given, weight is assigned in increasing order 1, 2, 3, 4, 5. Weighted profit 30,000 multiplied by 1. So product 80,000, 40,000 multiplied by 2, 50,000 multiplied by 3, 1,50,000, 60,000 multiplied by 4, 2,40,000, 70,000 multiplied by 5, 3,50,000. The weighted profit is 8,50,000 and the weights is 15. So weighted average profit is 8,50,000 divided by 15, which is 56,667. If goodwill is valued at 3 years of purchase of profit, the ninth is case of value of goodwill is 56,667 approx multiplied by 3, that is 1,70,000. However, if any of such trend is not visible from the figures of past profit, then one should take simple average profit and calculate goodwill accordingly. Let us suppose profits of a partnership for 5 years were 30,000, 25,000, 20,000, 30,000 and 28,000. In this case, there is no clear increasing or decreasing trend of profits. So, average profit comes to 26,600, arrived at by taking the simple average, that is 30,000 plus 25,000 plus 20,000 plus 30,000 plus 28,000 divided by 5. If the goodwill is valued by taking 3 years of purchase of profit, the 10th is case when the value of goodwill becomes 79,800. Weighted average is used when the profit is increased or decreasing trend. Higher weighted is always given to current year as it reflects more realistic view of the future profitability. Example: Example, the past profits of 5 years of partnership is 50,000, 40,000, 52,000, 48,000, and 56,000. Calculate the value of goodwill on the basis of 4-year purchase of the average profits of the last 5 years. Answer: total profits for 5 years equals 50,000 plus 40,000 plus 52,000 plus 48,000 plus 56,000, that is 2,46,000. Average profit equals sum of profits divided by number of years. Sum of profit is 2,46,000 over here, and it's a profit of 5 years. So 2,46,000 divided by 5 equals 49,200. Value of goodwill being 4 years purchased of the average profit of 5 years. We have calculated the average profit, that is 49,200, multiplied by 4 years of purchase equals 1,96,800. Next is super profit basis. In case of super profit method, goodwill is valued on the basis of super profits earned by the firm. Super profit equals actual profit minus normal profit. Actual profit is average profit. Normal profit equals normal rate of return, that is normal rate of return NRR multiplied by capital employed by the firm. The rationale of using the super profit is the partner who gains excess earning from owing to reconstitution of the firm should compensate to partners sacrificing at their share in the reconstitution. Super profit means excess profit that can be earned by the firm over and above the normal profits usually earned by similar firms under the similar circumstances in the industry. Under this method, the partner who gains in terms of the profit sharing ratio has to contribute only for excess profits because normal profit he can earn by joining any partnership firm. Under super profit method, that excess profit of a partnership firm can earn is to be determined first. Calculation of super profit. First, identify the capital employed by the partnership firm. Second, identify the average profit earned by the partnership firm based on the past few years figures. Third, determine NRR, that is normal rate of return prevailing in the locality of similar firms. Next, apply normal rate of return on capital employed to arrive at normal profit, and then deduct normal profit from average profit of the firm. If the average profit of the firm is more than the normal profit, the super profit exists and the goodwill also. I believe you understood. Let us suppose total capital employed by a partnership firm is rupee 1 lakh and its average profit was rupee 25,000. Normal rate of return is 22%. In case of similar firm working under the similar circumstances, similar conditions, the normal profit is rupee 22,000, average profit is 25,000. The partnership firm earns rupee 3,000 as super profits. A. Number of years of purchase method. Goodwill is generally valued by multiplying the amount of capital profit by certain number of years depending upon the expectation about the maintenance of such profit in future. If it is expected that the average profit can be maintained by another 5 years in future, then the value of goodwill could be taken as 3,000 multiplied by 5 equals 15,000. Next example, a firm of A, B and C has a total capital investment of 4,50,000. The firm earned net profits during the last 4 years as 70,000, 80,000, 1,20,000 and 1 lakh. The reasonable expected return is 15%. Having regard to the risk involved, Find out the value of goodwill of the business if it is based on 3 years of purchase of average super profit of the past 4 years. Average profit equals sum of profit divided by number of years. Normal profit is normal rate of return multiplied by the capital employed by the firm. Super profit is average profit minus normal profit. Total profit earned during the 4 year is average annual profit equals 3,70,000 divided by 4 years equals 92,500. Normal rate of return 4,50,000 is the capital investment, capital employed multiplied by 15%, that is NRR 67,500. Extra earnings is 25,000, that is 92,500 minus 67,500. This is known as super profit. Goodwill is valued on the basis of 3 years purchase of super profit, 3 years purchase of average super profit. So 25,000 multiplied by 3 equals 75,000. I believe you understood this. Next is annuity method. The major drawback of number of years purchase method is that the time value of money is not considered, although it was expected that super profit would be earned in 5 future years. Still, no devaluation was done on the value of money for the time difference. In fact, when money will be received in different point of time, its value should be different depending upon the rate of interest. If 15% rate of interest is considered appropriate, then discounted value of super profit to be earned in different future years will be as follows. Year 1, 2, 3, 4, 5, super profits is given, discounting factor at the rate 15%. For the first year, we need to discount it at the rate of 15%. So discounted value of super profit 3,000 multiplied by 0.8698. How this figure is calculated? 1 divided by 1.15. 1 divided by 1.15, 0.8695 equal to 0.7561. Again press equal to 0.6575. Again press equal to 0.5718. Again press equal to 0.4972. Discounted value of super profits is calculated, that is 10,056.60. The discounting factor is 3.3522 for 5 years. So under the annuity method, the discounted value of super profit becomes 10,056 and not 15,000. It was done under super profit method. The word annuity is used to mean identical annual amount of super profit. So for discounting, it is possible to refer to annuity table. As per annuity table, the present value of rupee 1 to be received at the end of each year for nth year is 15% interest per annum, that is 3.3522 that we have calculated. So value of goodwill under annuity method is 3,000 multiplied by 3.3522 equals 10,056.60. Example, calculate the value of annuity method of super profit from the following table. Annual maintainable profit after tax is 65,000 rupees. Capital employed is 4 lakh and normal rate of return is expected at the rate 12% per annum. Present value of annuity of rupee 1 for 5 years is 3.604776. Let us see how the calculation could be done. Annual maintainable profit is 65,000. The normal rate of return is 4 lakh multiplied by 12%, that is capital employed multiplied by NRR. So normal profit is based on capital employed and normal rate of return, that is 48,000. Super profit is 17,000, that is 65,000 minus 48,000. The present value of NET of 1 rupee for 5 years at the rate 12% compounded interest is 3.604776. That is given in the question. So 17,000 multiplied by 3.604776 equals 61,281. Capitalization of super profit, like goodwill, equals super profit divided by normal rate of return equals 14,167. So this is super profit. By capitalization of super profit is 17,000, capitalization is 12%, so divided by NRR 12%, 17,000 divided by 12% is 14,167. Capitalization of super profit method, the valuation of goodwill. Let's move ahead. Capitalization basis. Under this basis, value of whole business is determined applying normal rate of return. If such value arrived at by applying normal rate of return is higher than the capital employed in the business, then the difference is goodwill. The steps to be followed under this method are given below. A. Determine the normal rate of return. B. Find out the average profit of the partnership firm for which goodwill is to be determined. C. Determine the capital employed by the partnership firm for which goodwill is to be determined. D. Find out normal value of the business by dividing average profit by normal rate of return. E. Deduct average capital employed from the normal value of the business to arrive at goodwill. Goodwill equals normal capital minus actual capital. Normal capital equals average profit divided by normal rate of return. Let us suppose capital employed by the partnership firm is 1 lakh rupee. Its average profit is 20,000. The normal rate of return is 15%. Normal value of business equals 20,000 divided by 15%, that is 1,33,000, 333. Value of goodwill equals the normal profit is 1,30,000, the normal profit is 30, the normal value of business is 1,33,333, and the capital employed is 1 lakh, so 33,333 is the value of goodwill. I believe you understood. Normally the capital employed is the norm, as per the normal value of business is 1,33,333, but capital employed is 1 lakh by this form, so 33,333 is the value of goodwill, that is extra. Next example. The net tangible assets of the firm is worth 4,10,000 and the average profit for the last 4 years amounted to 60,000. Find out the value of goodwill if the reasonable return on capital invested is 12%. Capital invested in the business is 4,10,000. Normal rate of return NRR is 12%. Average profit earned by the firm is 60,000. Value of firm, that is capitalization of average profit, equals 60,000 divided by 12% equals 5 lakh rupees. Goodwill of the firm is value of the firm minus net assets. Net tangible assets is 4,10,000 and value of the firm is 5 lakh. So the difference is the goodwill, that is 90,000. Value of the firm is 5 lakh, net assets is 4,10,000. This is the valuation of goodwill. I believe you had understood till there. Let us continue. Illustration 1. Lee and Lawson are an equal partnership, that is 1:1. They agreed to take Hicks as 1/4 partner. For this, it was decided to find out the value of goodwill. Messrs. Lee and Lawson earned profits during the 2013 and 16 are as follows for 4 years. For 2013, the profits was 1,20,000. For 2014, the profit was 1,25,000. For 2015, the profits were 1,30,000. For 2016, the profits were 1,50,000. On 31st December 2016, capital employed by Messrs. Lee and Lawson was 5 lakh. The normal rate of normal profit is 20% required. Find out the value of goodwill following the various methods. Okay. Solution. Average profit. Average profit. Year 1, 2, 3, 4. Profit 1,20,000, 125, 130 and 150. 1,20,000, 1,25,000, 1,30,000 and 1,50,000. The profits is in increasing trends, so we'll give weights to it. 1, 2, 3, 4. Higher weight is given to recent profit. Weighted profit, weighted profit. 120 multiplied by 1 is 1,20,000. 1,25,000 multiplied by 2 is 2,50,000. 1,30,000 multiplied by 3 is 3,90,000. 1,50,000 multiplied by 4 is 6 lakhs. Total 13,60,000. Weights are 10. Weighted average profit. Weighted average profits equal 13,60,000 divided by 10, that is 1,36,000. I believe you understood. Method 1. We are calculating by method 1. First method, that is average profit basis. Average profit basis. The weighted average profit is 1,36,000. The weighted average profit is 1,36,000. Years of purchase is not given in the question, so we need to take an assumption. Assumption 3 years of purchase. So goodwill equals 1,36,000 multiplied by 3 years of purchase, which is 4,08,000. You can also take different, like 2 years of purchase assumption will also be done. There is no issues. Next method. Method 2, super profit basis. Super profit basis. Average profit is 1,36,000 less normal profit capital investment multiplied by NRR, 5 lakh multiplied by 20%, 5 lakh multiplied by 20% is 1 lakh. So 36,000 is the super profit assumption. Goodwill is valued at 3 years purchase. So goodwill equals 36,000 multiplied by 3 years, which is 1,08,000, I believe you understood. Let us continue. Next method is annuity method. Assumption. Interest rate is equivalent to normal profit rate, that is 20% per annum. Next, goodwill is valued at 3 years purchase. Goodwill equals 36,000 multiplied by annuity factor. Annuity factor needs to be calculated. So here 2 years are there. Discounting factor is 20%, which is we have taken it as assumption. So 1 divided by 1.20, 20%. So 1 divided by 1.20 equals 0.83 equals 0.6944 equals 0.5787, and then GT, the grand total. So for 3 years, first year it is 1 divided by 1.20 is 0.8333 equals 0.6944 equals 0.5787. Total is 2.1065. Total is 2.1065. This annuity factor needs to be taken over here. 2.1065 equals 75,834. The value of goodwill. Next method. Method 4. Capitalization basis. Capitalization basis normal value of business equals 1,36,000 divided by 20 multiplied by 100, which is 6,80,000 less capital employed in Messrs. Lee and Lawson. They had already employed the capital 5 lakh. 1,80,000 is goodwill, the value of goodwill. The normal value of business is calculated. So average profit is 1,36,000, and that is 20%. So multiplied by 100 divided by 20, 6,80,000 is the 100% value of the business. 136 multiplied by 5, so 6,80,000 less capital employed 5 lakh, so goodwill is 1,80,000. I believe you understood. Let us move ahead. Illustration 2. The following particulars are available in respect of business carried on by Mr. Rathod. Particulars amount: capital invested 1,50,000. Trading results for 2013, there is a profit of 40,000. In 2014, there is a profit of 36,000. In 2015, there is a loss of 6,000. In 2016, there is a profit of 50,000. Market rate of interest on investment is 10%. The rate of risk return on capital invested in business is 2%. Rate of risk return. Remuneration from alternative employment of the proprietor is 6,000 if not engaged in business. Rupees 6,000 per annum. You are required to compute the value of goodwill on the basis of 5 years purchase of super profit of the business. Calculate the average profit of the last 4 years. Okay. Solution. Particulars amount rupees. Trading profit which is given in the question for 2013, 2014, 2015 and 2016. For 2013 it is 40,000. For 2014 it is 36,000. For 2015 it is loss of 6,000, and 2016 it is 50,000. 40,000 plus 36,000 minus 6,000 plus 50,000. 1,20,000. Average profit 4 years, so divided by 4, 30,000. 30,000 less remuneration, less remuneration for the proprietor. Annual remuneration of the proprietor is 6,000. So average profit earned less remuneration of the proprietor, that is sacrificed. So 24,000 is the average maintainable profit. Less normal rate of return, which is 12% on capital employed. 12% on capital employed. Capital employed is 1,50,000. So 1,50,000 multiplied by 12%, it is 18,000. 6,000 is super profit. 6,000 is super profit. And goodwill is calculated at 5 years of purchase. So goodwill at 5-year purchase of super profit, 6,000 multiplied by 5 is 30,000. 6,000 multiplied by 5 is 30,000. I believe you understood. I believe you understood till here. Let us continue. Next concept is hidden or inferred or implied goodwill. Sometimes the value of goodwill is not specifically given and has to be inferred or implied from the arrangement of capital, from the arrangement of capital or profit sharing ratio or profit sharing ratio. For example, for example, A's capital A's capital is rupee 20,000 and B's capital is rupee 15,000 and they share profits equally. They shared profits equally. C is admitted as a partner with rupee 18,000 as his capital, 18,000 as his capital for one-fourth share, one-fourth share in the profits. The total capital of the firm now ought to be rupee 72,000 for for simple reason simple reason that if C contributes rupee 18,000 for one-fourth share, then for full or unit profit he ought to have contributed rupee 72,000, that is basically 18,000 multiplied by 4, but the total capital of A, B and C becomes only rupee 50,000 over here. So the hidden value of goodwill should be taken as rupee 22,000, that is 72,000 minus 50,000, so that the total capital becomes rupee 72,000. The total capital becomes 72,000. I believe you understood. This. Let us move ahead. Need for valuation of goodwill. Whenever there is any change in the existing relationship of partners in TERS, some partners have to sacrifice their profits and some others would gain. Those who sacrifice future profit should be compensated by the others who are gaining. This adjustments of partnership right may arise due to admission of a new partner, change in the profit sharing ratio, retirement or death of a partner, and the dissolution of partnership firm. The partners who gain the terms of profit sharing ratio have to pay for such gain as to proportion to the value of goodwill. The partner who lose in terms of profit sharing ratio receive payments for the sacrifice as a proportion of value of goodwill. Dissolution of the partnership firm is not covered in the study material and will be discussed in intermediate level course study material. Let us continue. Valuation of goodwill in case of admission of a partner. How will value goodwill in case of admission of a partner? When a new partner is admitted into a partnership firm, certain adjustments in account becomes necessary. Chiefly, this is because the new partner will acquire a share of profit of the firm. Because of this, the old partners will stand to lose. Suppose A and B are partners sharing profits and losses in the ratio of 3 is to 2. If their profits are 20,000 and will get 12,000, if their profits are 20,000, A will get 12,000 and B will get 8,000 because their ratio is 3 is to 2. If C is admitted and the given 1/4 share in the profits, then out of 20,000 he will get 5,000, that is 1/4. The remaining 15,000 will be divided between A and B. A will get 9,000 and B will get 6,000, that is in the ratio of 3 is to 2. Thus, on C's admission, A loses 3,000 per year and B loses 2,000 per year because earlier A used to receive 12,000 but now A is receiving only now 9,000, so A will lose 3,000. B will earlier receive 8,000, now B will receive only 6,000, so this means B will lose 2,000 per year. C will have to compensate A and B for this loss. It is no argument to say that C's admission the profit will not remain as 20,000. Extra profit will arise and therefore A and B will both get more than what they previously got. But it should be noted that the additional profit will be earned by the combined efforts of A, B and C together. Therefore, if A and B get a share of extra profits, they are not particularly obliged to C. Out of the present profits of rupee 20,000, they have to give up their share in favor of C and therefore they are entitled for a compensation. The problem of compensation is the chief problem while dealing with admission of a partner. This is tackled through goodwill. But one point should be made clear here. Goodwill is a compensation to old partners. Compensation to old partners for their sacrifice in connection with the admission of a new partner. So it is to be credited to the partners according to their profit sacrificing ratio. Whatever share the new partner is getting, it may be sacrificed by the old partners in proportion to their old profit sharing ratio or in the different proportion. Let us move ahead. Example: Nigam and Dhameja are in a partnership sharing profits and losses equally, 1 is to 1. They agreed to take Ghosh as 1/3 of the partner. So Ghosh is entering into the firm as 1/3 partner. Now 1/3 share of Ghosh may come out of sacrifice made by Nigam and Dhameja equally. that is at their old profit sharing ratio, which is 1:1, the following profit sharing pattern. Partners Nigam Dhameja will sacrifice Nigam and Dhameja will sacrifice one half of 1 by 3, that is the share of Ghosh. So old share of Nigam is 1 by 2, Dhameja 1 by 2, and Ghosh is a new partner, so there is no old share. New share will be on the basis of sacrifice. So Ghosh share is 1 by 3rd, new share. The sacrifice made by Nigam and Dhameja is this 1 by 3rd is to be shared between 50%. So 1 by 2 minus 1 by 3. This is 1 by 6 is the sacrifice and 1 by 6 is the sacrifice of Nigam and Dhameja. 1 by 6 and 1 by 6. And Nigam will sacrifice 1 by 6 and Dhameja will sacrifice 1 by 6. That consists of Ghosh share, which is 1 by 3. So 1 by 6 plus 1 by 6 equals 1 by 3. This is the Ghosh share. I believe you understood. The new profit sharing ratio will be 1 by 3 for Nigam, 1 by 3 for Dhameja, and 1 by 3 for Ghosh. In other words, 1/3 of the share of Ghosh was borne by Nigam and Dhameja in their old profit sharing ratio. By this process, the Nigam sacrifice 1 by 2 minus 1 by 6, 1 by 3 equals 1 by 6. 1 by 2 is the old share, previous share, and 1 by 3 is the new share. So sacrifice is 1 by 6 in share, and Dhameja will also sacrifice old share, old ratio 1 by 2, new share, new ratio is 1 by 3. So 1 by 6 is nothing but sacrifice. So the profit sacrificing ratio will be Nigam and Dhameja 1 by 6 and 1 by 6. Ratio will be 1:1. That is equal ratio, which is the same as profit sharing ratio. But if the new profit sharing ratio of Nigam, Dhameja and Ghosh will become 4:2:3, then profit sacrificed by Nigam and Dhameja on Ghosh admission is not at the old profit sharing ratio. In this case, the profit sacrificing ratio is as follows. Nigam's old share is 1 by 2. Nigam's new share is 4 by 9. 4 by 9, 4 plus 2 plus 3, 4 by 9, 2 by 9, 3 by 9. So Nigam's sacrifice is 1 by 18. In case of Dhameja, the old share is 1 by 2 and the new share is 2 by 9. So sacrifice is 5 by 18. So 1 by 18 plus 5 by 18, the sacrifice by Nigam and Dhameja will consist the share for Ghosh. The sacrificing ratio will be 1:5, 1 by 18 and 5 by 18. So 1:5. If Ghosh pays goodwill of 24,000, then in the first case, Nigam and Dhameja should share equally. That is 12,000 and 12,000. But in the second case, the Nigam should get 4,000 and Dhameja should get 20,000 in their ratio of 1:5. So 24,000 multiplied by 1 by 5 and 24,000 multiplied by 5 by 6. It is 1 by 6 and 5 by 6. I believe you understood. It is 4,000 and 20,000. This is Nigam and this is Dhameja. Take another example. Nigam and Dhameja are equal partners. They agreed to take Ghosh as 1/3 partner. The new profit sharing ratio is 4:2:3. Nigam and Dhameja agreed 27,000 as value of goodwill. In that case, The Nigam's sacrifice is 1 by 18 and Dhameja's sacrifice is 5 by 18. So 27,000 multiplied by 1 by 18 and Dhameja 27,000 multiplied by 5 by 18. It is 1500 and 7500. The entry would be gaining partner's capital account debit to sacrificing partner's capital account. Gaining partner is Mr. Ghosh, so Ghosh capital account will be debited by 9,000 and sacrificing partner is Nigam and Dhameja, so the account will be credited as 1500 and 7500. As per the accounting standard, it is not recommended to raise goodwill account but to show the adjustment of goodwill through partner's capital account. So in this example you had seen the goodwill account is not raised, the partner's capital account is adjusted accordingly. I believe you understood. For journal entry, just write gaining partner's capital account should be debited. Gaining partner's capital account debit to sacrificing partner's capital account. Over here gaining partner is Ghosh, so Ghosh capital account debited 9,000 and Nigam's and Dhameja's partner's capital account is credited. Therefore Ghosh capital account debit 9,000 to Nigam and Dhameja, to Nigam capital account 1500 to Dhameja capital account 7500. I believe you understood. I believe you understood till here. Let us see what we have done in today's class quickly. So we have started with valuation of goodwill. We have learned that goodwill is calculated by the following methods. So we have understood the necessity for valuation of goodwill in case of change in profit sharing ratio, in case of admission of a partner, in case of retirement of a partner, and when business is dissolved or sold. The methods of valuation of goodwill is annuity method, super profit method, average profit method, and capitalization method. We have learned all the methods thoroughly. We have understood the value, the meaning of goodwill, that is business reputation, why it's calculated, recommendation of accounting standard for the valuation of goodwill, how it is measured, methods of valuation of goodwill, average profit method, super profit method, and capitalization method. We have done several examples in relation to it. In first illustration, we have calculated goodwill by all the four methods. Then we had learnt about the hidden or inferred or implied goodwill, need for valuation of goodwill, and valuation of goodwill in case of admission of a partner. Seen an example. We are keeping it till here today. We are keeping it till here in this lecture. Thank you. Thank you.